Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. This will be the final lesson in our US Stock Financial Report for Beginners course. In the previous lessons, you learned a lot of valuable information, and you mastered a method of trading stocks by combining analysis of company financial reports with stock valuations. So, besides financial reports and valuations, what other factors affect the price of a stock? Financial reports and valuations are considered micro factors that affect stock trading. If we can talk about micro factors, there certainly must be macro factors that affect stock trading too. In this lesson, I'm going to show you the Big Five, the 5 rudimentary factors that affect stock trading in the real world. The first factor is fundamentals. Fundamentals can be divided into 2 types. The first type is micro fundamentals. For example, what we have learned about corporate financial reports, corporate governance, the competitive environment, and industry profiles are all kinds of micro fundamentals. The second type is economic fundamentals, which simply means assessing the general trend of the market. If you think of stock price and economic fundamentals as the relationship between a boat and the water, then it's easy to see that when the tide rises, the boat will naturally rise too. So, how you think the market is going as a whole will have a big impact on the trades you make. In a bull market, the general market trend is up, and as a result, most stocks will rise. Likewise, in a bear market, when there is a downtrend, even quality stocks can get slaughtered. So, what indicators can you use to determine the general market trend? For US stocks, important economic indicators are things like the Federal Reserve interest rate, non-farm payrolls, PMI, PCI, and PPI. Most of the time, you can find this data in the financial news, and the information I'm about to give you will help you understand that data. So, if you're interested, stick with me. Looking at macroeconomic data first, and then assessing the fundamentals of a company is often called top-down analysis. The second factor is capital. The capital side of the market refers to the amount of money sloshing in the stock market. If there is a lot of money flowing into the stock market, the more favorable it is for the stock market. On the other hand, less capital is a negative for the stock market. I'm sure you've all heard the word liquidity used in relation to the stock market. If economic fundamentals are like water, then liquidity in the financial markets mainly refers to the level of capital entering the markets. If the level of liquidity rises, then stock prices will naturally go up too. For investors, this kind of money coming into the stock market is a big plus, and it usually makes them want to trade stocks even more. It should be well noted, though, that with such inflows more is not always better. It's a double-edged sword. When there's too much money in the market, it often leads to an overheated economy and overly optimistic trading sentiment. At times like this, the price of many low-quality stocks can go super high due to speculation. Many investors who never cared about the stock market can afford the temptation, get into the market, chase prices up, and finally leave the market with a big loss. Looking at the second factor, capital, you can determine whether there is a good market liquidity. And a good liquidity often means a good trading environment. But too much liquidity in the market can cause an overheated economy and increasingly risk for investors, which could present a sharp downward price correction. The third factor is policy. Simply put, stock market volatility can be caused by changes in government policies. We can generally divide policy into 3 categories: monetary policy, fiscal policy, industrial policy. In the US, the Federal Reserve is in charge of monetary policy. Their main job is to make decisions about policy based on how the economy is doing at different times. If there's too much money coming into the markets, they'll close the spigot to reduce the flow. And if there's too little money in the market, they'll open it up to increase liquidity. Fiscal policy lies in the hands of the government. When the economy is bad, the government will push to develop infrastructure and will increase government spending to stimulate economic development. When SMEs are having operational difficulties, government fiscal policy can help them get through it by giving them targeted tax relief and taking other actions. Monetary policy focuses on capital flows, and fiscal policy is more inclined to focus on taxes. Through the 2 invisible hands of monetary and fiscal regulation, the government keeps an eye on the economy and makes sure it grows in a healthy and orderly way. Industrial policy is the national policy of supporting or restricting the expansion of certain industries. For example, in order to slow global warming, developed countries are beginning to transition to new energy sources, reducing their use of traditional non-renewable energy and increasing their use for alternative clean energy. With these policies in place, local governments support eligible companies, and many renewable energy stocks will enjoy not only the favor of such policies, but will also receive the benefit of government funding. As a result, their share prices will be skyrocket. So, in trading, we talked about following the trend, which includes not only monetary and fiscal policy, but also national government policy for certain industries. So, the third bowl of noodles says you should be alert not only to the amount of money in the market, but also to whether the industry of the stock you're trading has the support of beneficial government policies. The fourth factor is technical analysis. Technical analysis is a method of making buy and sell decisions by looking at stock charts. Learning to read technical charts is a must for every student who invests or plans to invest in stocks. There are generally three types of technical indicators. The first is the technical indicators of trend. These include indicators such as moving averages and Bollinger Bands. Trend-based technical indicators are the most basic, and they can help you determine the trend of a stock or a market. The disadvantage is that they're lagging indicators in that they generally lag behind current market activity. The second type of indicator is the oscillators. The basic function of all oscillators, such as KDJ, RSI, and WMS, is simply to measure whether a stock is overbought or oversold. So, although these indicators use different formulas and have different names, they're actually very similar in their effect. The third type, the composite technical indicator. The most common indicator of this type is the MACD, which can be used in many ways. You can use MACD red and green candlesticks to determine the direction of trading activity. You can assess the current upward or downward moment according to the length and color of the candlesticks. You can use the golden fork and the dead fork to make market predictions. To identify trend reversals, you can use the divergence or convergence of top and bottom MACD lines to catch the price trend tops and bottoms. Because technical analysis is very important, I'll be giving a special class later on to take a deep dive into it. For today, I won't be going into detailed explanations. In this lesson, you really only need to know that technical indicators are another of the factors that affect stock trading. The fifth factor is the news. The news is of great concern to traders and is one of the most important factors affecting stock market volatility. Friends will often tell me that someone recommended a stock for them, and they will ask for my help to see whether they should invest in it or not. Or they don't know how to confirm if a news item is just rumor and opinion, or whether such and such stock is the subject of institutional speculation and so on. Or they've heard that a certain industry will be greatly affected by an international conflict. Information that influences the way investors make decisions about how to trade is collectively referred to as news. Market news can be true as much as it can be false. Investors must look at the news without being distracted or swayed by rumors and opinions that can affect their decision-making. So, this last factor tells us that the news has a big impact on our investment decisions, but that not all news is true. You will need to gain and use the ability to tell if a news story is true or false, and to predict how it will affect stock prices in the future. You have to shut out the noise. Now, after learning about the 5 factors, you must be wondering, how do I apply this knowledge in practice? It's actually quite simple. When analyzing stocks, experienced investors will first look at macro factors to determine whether overall market conditions make for a suitable investment environment. They then select industries that enjoy governmental policy support, and finally, they select the leading companies within those industries as investment targets. You see, this is the kind of top-down analysis we've been talking about. I've put together the following chart, which with the case studies we've looked at, can help you clearly remember this method. So, do you know how to use the 5 factors now? Today's lesson added to our knowledge of financial reports. You learned that, in addition to company financial reports, there are many other factors that can determine the price of traded stocks. All of these elements are included in the 5 factors. We can divide the factors into 2 parts, news and policy, which can be called factors of macro analysis, and capital and technical can be called factors of micro analysis in investment. Fundamentals is a bit of both. Well, that wraps up our course on financial reports. You'll learn a lot about financial reports and how to use company financial data to screen for the stocks of quality companies. In addition to learning more about financial reports, you also learned 4 things about trading stocks, which mainly include how to use valuation to make trading decisions and how to assess the 5 factors that affect stock prices. I think this will help you a lot when you trade stocks. The road to successful stock investing is long. Visit us at TTM and then at Tiger Academy, where I will bring you more investing knowledge. We'll also be offering more courses in the future. I hope to accompany you on the road to smart investing.